Hey, I'm Neil at Neil CPA. I wanted to take some time today to talk about the short-term rental loophole. Not a loophole at all, really. It's just that the rules around this specific idea are a lot easier for real estate investors to employ over a true real estate professional election. So it gives you some of the benefits of accelerating depreciation in real estate that a real estate professional would enjoy. And the things that you have to do to qualify to use this idea are considered a lot less onerous than what one needs to be able to show to be a full-blown real estate professional. Later in this video, I'm actually going to discuss an idea that's a pitfall I don't think is brought up in most content I've seen on this subject. So stick around for that. So why does a short-term rental attract people? Why do we call it a loophole? Number one, you can buy real property and do things like cost segregation studies to accelerate depreciation on it. And if you follow the rules of a short-term rental, you get to potentially generate ordinary losses in the first couple years of owning and operating a short-term rental that would offset a high income couple or individual's ordinary wages or other investments. Okay, so just real basic. I have an article, blog on this. I'll link it in the comments. But the couple things that you need to be able to qualify for a short-term rental is that the average stay needs to be under 7 days. And the reason why that is the IRS kind of looks at Airbnb or that type of short-term rental as more of like a hotel room than, an extended stay vacation rental or a long-term rental where the tenants would lease monthly or annually or potentially even longer periods. To maximize the benefit of a short-term rental, you really should be looking at this project as a 100% business use project and not like a typical second home, vacation home type project. While if you're real good about it and you stay under the 14-day de minimis personal use, everything still works. But you just need to keep in mind that with taking these large deductions, there are pitfalls that I'm going to get to later in this video if you break the 100% business use rules. So the IRS has looked at short-term rentals kind of more like hotels, and that's what takes them out of this passive income category and puts them more into an ordinary business type category. It's important you don't provide too many services to your short-term rental tenants because that then could recharacterize the income as subject to self-employment tax, which most real estate investors are trying to avoid any more taxes. So the other thing that has to happen to move this from passive to ordinary is you do have to materially participate in the activity. This can often be achieved pretty easily in year one if you go into a project and fix it up and buy all the equipment and furniture and linens and the scullery ware, the forks, knives, and all that stuff. If you visit it and paint it and tweak it, you work on the listings. The IRS says you only need to get 100 hours to be considered materially participating. And I'm not going to go through the 7 material participation tests in this video. There's tons of content out there on that. Before you pull the trigger on any of these ideas, you should be talking to somebody like me or your own advisor on making sure that you do check all these boxes. But you do have to pass one of the material participation tests to reclassify even a short-term rental to ordinary. And so as tax advisors, we're always trying to find ways to create deductions for our clients. And that's why this short-term rental thing is pretty interesting, because you can go invest in real estate, generate large deductions, buy an appreciating asset. It's not like you're going to go buy 3 trucks to lower your tax bill, but you're actually buying, hopefully, an appreciating asset. So all these things make this a strategy that's worth talking about. Okay, so I had mentioned at the beginning of the video, I really wanted to discuss a pitfall that I don't ever see talked about. And it's this idea of a recharacterization. And so I've had clients come to me with this idea. They found content on a short-term rental and they want to discuss it. and how they might be able to employ it. And some of those folks are looking at this as maybe a 1 to 2 year tax deduction that's going to help them park large income against this investment, kind of level their tax bill off. And then maybe they'll convert the short-term rental in a year or two to either, more of your typical vacation home where their personal use will go up and above the 14 days, or maybe they're even looking at it as their primary residence in a year or two after they finish up their businesses and close down things. Something I never see really talked about is this whole idea of recharacterization. And so if you go to a cost seg and you generate $100,000, $200,000 of accelerated depreciation in the 5-year personal property category, so that's going to be your flooring, your cabinetry, your countertops, all your appliances, electrical feeding the appliances. If you go off and you generate this large deduction, the IRS says if your business use changes, you have to look at recharacterization of these personal assets every year. So if you go 100% year one, and we're in 100% bonus land, which means you take that full deduction in year one, if you then change it to 0% in year two, you're looking at having to recapture all of that depreciation you took in year one and put that on your tax return as income in year two. I don't see this talked about enough. And so really, when I'm talking about short-term rentals with my clients, I am trying to make sure that their intent is to do this at least for 5 years, which is the useful life of personal property. And so once you're over the 5 years, you don't have to look at recharacterization again of things that you took, at least 5 years prior. And then the real property depreciation it's not subject to recharacterization. So your land improvement portion of a cost segregation study and then your real property, it's also not subject to recharacterization. But the 5 years is really what we're going for. Sometimes the 15-year is real juicy and we get some good numbers, but the 5-year is what we're going for when we're trying to build that big ordinary loss. So it's important before you step into this loophole that you understand you need to be in it for a while, or you could have some things come back on you. Okay, so the ordinary passive portion of a short-term rental, that is determined each year. So you may have your 100 hours of active participation in year one, but then you need to consider year two, how that's going to look. Are you going to have the active participation? And so you may be reclassifying this investment as passive later down the road. The depreciation rules for an ordinary activity versus a passive activity aren't different. So as long as the business use is still 100%, that recapture pitfall I just talked about shouldn't come into play. But it's important that if you're doing this yourself, or if you're working with a tax advisor, that you're kind of aware of what your active participation level is year over year, and that you're updating the activity correctly. I briefly messaged the personal use threshold. Basically, you want to stay under 14 days of personal use during the year and have the short-term rental available the rest of the year. So available to rent, listed for rent, etc. You don't want to get into where you have to look at personal use versus business use allocation because you don't make it available for the full year. Hey, it's that time in the video where I just like to ask my audience, if you're getting anything out of this video, please like or comment. If you feel like hitting the subscribe button, please do so. I really appreciate it. It keeps me motivated to make content like this. It is not a loophole. It's not an automatic check the box. There are still things that you have to maintain in terms of records for active participation, and also to show that it truly is 100% business use type of property. So your listings, your availability schedules, your bookings, etc. The other small part of this loophole that I don't think gets talked about directly in content is your placed in service date. Understanding that if you buy a place in tax year one, so it's 2026 right now, but if you bought the property in 2025 and it wasn't available for use, but you're thinking because you bought it in 2025, you're going to qualify in 2025 and get to take a big tax deduction in 2025. You have to be careful there. The property needs to be available for use basically you need to have a listing. It's not necessary that it was booked, but it needed to be available for use. And then you cannot prorate your material participation hours. And so maybe you knew buying it at 2025, you weren't going to have it ready for 2026, and you were planning on taking the deduction in 2026. That's fine. But if you spent 75 hours in 2025 and you're only really planning on spending 25 hours in 2026, you're not going to get up to your 100 hours of active participation because you don't get to carry over those hours from the prior tax year. So I've mentioned a couple times in this video, but this is not a loophole, and it's really important that you do some planning around it. And before you start banking that you're going to have a $100,000 to $300,000 ordinary loss to take against your ordinary wages in a tax year, that you get in front of somebody like me and you actually talk through exactly what you're trying to do, what you hope to accomplish with the acquisition, i.e. you want, to spend half the year there. We're up here in Oregon, and we have a lot of folks that buy places down in Arizona, right? The loophole sort of breaks when you rise your personal use above those 14 days for the entire year. So I don't know how long this video is going to end up, but if you are shopping around for loopholes and you saw a short-term rental loophole and thought, wow, this will be real easy to dip our toe into and get some big tax deductions, it's probably not right for you. There's still a good deal of tax issues to deal with on these. There's getting a cost segregation study done to really maximize the benefits. There's tracking expenses and income, just like any other business. And there's having a holding period in, a market, and real risk to whether or not you're able to maintain it as a short-term rental and turn a profit. So like anything, when I'm talking with clients, I'm not advising clients to buy things that they don't need or to buy things that won't help them long-term achieve their goals if all they're trying to do is mitigate a large tax bill. So if you really want to understand where this plan will help versus where it will hurt, feel free to reach out in the comments, like and subscribe. Go to my website at neil.tax if you're looking for an advisor or somebody to help you with tax preparation. I've got scheduled fit calls there on the website, and I'm happy to talk to people that are looking on getting into short-term rentals. So again, my name's Neil CPA. Thanks for watching. I'll look for you next time. Thanks.